So anyway, what happened to me was I was with my Shearson broker, didn't know anything about trading, and I ended up, I don't remember why he told me I should do this, but I did it. Well, I just did it because I thought he knew what he was doing, but I don't remember the reasons why he told me to do it. I ended up buying silver at it was around $9.75 an ounce, and I bought two 5,000 ounce contracts. So I was long 10,000 ounces of silver. And shortly after I got into the position, the silver market went down to about $9.50, and so I was looking at a $2,500 loss. So what he says to me is that, you know what, we'll take care of the situation. Since I was long two COMEX silver contracts, what we'll do is we'll spread your position between New York and Chicago, and we will go short two contracts in Chicago. So what he did is he put on 2 contracts, another a $280 commission, by the way. So he put on 2 contracts in Chicago. So I was long New York, short Chicago at this price. And he said, when the market goes back in your favor, we'll take the short leg off. Because the whole idea originally was to be long silver, okay? So we'll take the short leg off when the market goes back in your favor. So the market did, it went back in my favor, and he took these 2 short contracts off, but in essence locked in what, a $2,500 loss when he did, right? Okay? That was a realized loss. But then what happened is that the market went back down to $9.50, and he put the 2 back on. What? Now, what I'm about to show you is, in essence, the silver market went into about a 2-week trading range between $9.50 and $9.75. I didn't know what a trading range was. I didn't even see a chart, okay? And I would say that he probably didn't either. Go looking back in the situation, he didn't know what a trading range was either. But what he did do is that every time it went back to $9.75, he took the short leg off, locked in another $2,500 loss. It went back down again to $9.50. He put them back on, and it went back up to say put them on. So he did this over a 2-week period several times. And finally, it got to the point where I couldn't open up my brokerage statements, and I was in an extreme state of distress. And until I got to the point where I just woke up one morning, I said, I can't take this anymore. And I went into my office and I called him up. I said, just get out of it. Just get out of everything right now. Oh man, this is probably the reason why I'm here today. Okay, I'm not kidding. In fact, it is, because about I'd say 20 minutes or half an hour after making this call to get out of everything, the market finally broke out. The market finally broke out of this trading range. Yeah, no, this isn't it. No, this is the worst part of it. The market finally broke out of this trading range, and of course, we never saw this price again because shortly thereafter, within a couple of weeks, you remember the Hunt Brothers debacle? Okay, I was in what you call the perfect trending market. It couldn't, and I say the perfect trending market, I mean it was absolutely, because what's a perfect trending market? One that virtually goes straight up, right? Okay, no retracements? Well, the market couldn't go straight up because the exchange imposed price limits. In other words, the exchange says that the price of anything can't deviate by more than, let's say in silver, I think it was 50 cents a day. I think it started out, it was 50 cents or $1 a day. I don't remember what it was. Anybody remember what the price limit was on silver? Tony, do you remember? Back in the early 80s or late 70s, what the price limit on exchange imposed price limit on silver was a day? Was it 50 cents or $1? It had to be $1. What?
I think it was $1.
Well, yeah, it started out at 50, but it went to $1.
Well, he had 3 limits in a row. Then they started.
Yeah. Okay. So you know what I mean by limit move? Everyone knows what I mean by limit move. Okay. In other words, when the price went to let's say 10.25, we started out at 9.75. We would start out at 9.75. If the price went to 10.25, that's a 50-cent move, and the exchange says, okay, we're not going to execute any more buy orders. It doesn't matter unless there's enough sell orders. Unless there's sell orders, of course, to take the other side. But if there aren't enough sell orders, we're not going to execute. In other words, we're not going to let the price go any further than 10.25 today. Okay? Now we don't know what's going to happen tomorrow morning when the market opens. But in this case, instead of having a bar chart that looked like this, because a bar chart would imply that there were trades within those bars. The silver market, in our charts, the silver market looked like this. They were dots. This would be a day, this would be a day, this would be a day, this would be a day. They were dots because there were no trades. because there wasn't anybody willing to take the other side of these buy orders. In other words, we had a flood of buy orders into the market without any inventory to take the sell side, so the exchange had to move it up the limit for the next day, and then there weren't any sell orders, limit up again. This would be a perfect trending market because you don't have to deal with retracements. Okay? And then it went all the way up to $49 an ounce. Basically, I was like that close to, in my mind anyway. I'd have never hung out to 49, but at least at the time, I was like that close to what I thought was $400,000 on a 2-lot.
And it didn't take long.
And no, it took 30 days or so. It'll go over 30 days. Now, the reason why this happened is because the Hunt brothers, who were Texas oil millionaires or billionaires or whatever, they got the idea that they were going to corner the silver market. And the way you corner a market is, one, you start buying up as much cash silver as you can. You start accumulating a huge inventory of cash silver bars, whatever, okay? And then what they did is they went into the futures market and bought as many futures contracts as the exchange imposed limits would allow them to. However, that was quite a few futures contracts. But see what they did, and the reason why they ended up taking a huge hit on this whole deal is because the exchange said that what they did is they bought more than the limit through other entities that they said they had no relationship with, but the reality is they did. So here's the deal. Here's how a market gets cornered. Is that if there's a buyer for every seller and a seller for every buyer, and at some point futures contracts expire, and when they expire, if we're not out of our side of the contract, we have to execute the contract. So if I'm on the buy side of this futures contract and I don't get out when the contract expires, I have to deliver 5,000 ounces of silver to whoever's on the sell side at the particular grade that the contract specifies at the price that I got into the contract with. Everybody with me on this? Okay? And as a seller, if I'm not out, I have to take delivery. Well, what ends up happening is that as contracts come to expiration, everyone starts unwinding their trades. Meaning the buyers sell, the sellers buy, and what once existed as open interest starts reducing down to very little, if almost nothing, and the few that are left are the ones that want to take delivery or make delivery. Everyone else had no intention of taking or making delivery, but what the Hunt brothers decided to do was they wouldn't let the sellers out of their contract. In other words, what they did is they'd accumulated tens of thousands of buy contracts with no intention whatsoever of unwinding that contract, of actually selling it before expiration, forcing all the sellers on the other side to go into the cash market and deliver silver to the Hunt brothers. And at that point, the Hunt brothers had so much silver, they're basically having to buy the cash silver from the Hunt brothers to deliver silver on their futures contracts, forcing the price of silver to go up $40 an ounce. Is everyone with me on this? And then when the COMEX said, hey, you know what? COMEX said they said no more buy orders or whatever. Anyway, what went up, limit up 40 some days in a row, and limit down 40 some days in a row. And the Hunt brothers took the gas on it. They ended up losing all that money. Is that what they did? I don't remember what they did exactly. Yeah, right. They said they're only taking sell orders, right? Yeah, well, whatever it was, yeah.
Right. And do you mind if I just jump in?
Yeah, go ahead. No, come on. Yeah, go ahead. You need the mic? You need the mic?
No, I got a good point.
Okay.
The market's going to do, don't ever think a market can do, always can never do that, because the market can't go wherever it wants to because it can. And during this Hunt brother with silver going limit down 8 days in a row, the chairman of the CME, Jack Sander, had a hog position on it. And there was a report on it. And the report was very bullish for hog should have gone limit out. It was limit down for 3 days in a row because silver was going. And Jack Sander was the chairman of the Chicago Mercantile Exchange, and this was limit down away from being bought. And that would not have made the Mercantile Exchange, which was still kind of in its, infancy, shall we say, not even its infancy, but it's
yeah, pretty much though, yeah.
And that would have made the exchange look good. they were limit down for the third day. He walked out of the exchange and went to St. Peter's Cathedral. And came back and the market turned around. But the last thing that I want to say is, it doesn't matter what you're trading. Something else, especially in these markets today, something else can go wrong. And you're like, well, why is that affecting my stock? Because it can. Because it can. You know, psychology has to go in there. Oh, right. Sorry. But anyhow, a market can go wherever it wants. And just don't think that it can't. You know, and I'll throw one more thing out there. In 1987 during the crash, if you were short puts, S&P puts, you obviously got hammered. If you were short calls and the stock market went out 500 points in one day, you got hammered because volatility.
Oh, volatility, yeah. Right. Right.
So
I've been on the wrong side of one of those. The market's going in my favor, and because I shorted the puts, it was in the D mark, and the market was screaming in my favor, and I'm losing money because of the volatility.
right, yeah.
I didn't think. I mean, I knew theoretically it could happen. When it really happened, it's like, oh, okay, this really happens.
And, you know, these were market makers that went out of business during the crash, and they had lines. You know, they went home and told their clients, you know, we're broke. I mean, we're broke. You know, and they took up the clearinghouse. You know, the next day, you know, I know my husband's cheating on me. You know, blah 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 blah. I know he's not cheating on you. We will take the fur coat and the ring.
Wait, hold on. Okay, just a little off, but just because you're on the floor. Do you personally know anybody that did a Rio de Janeiro trade?
Oh no, but I never did. But
Do you know anybody that did, or
no, I never did.
does anybody know what a Rio de Janeiro trade is? What do you think of it? What do you think it would be? No, it would be some trader, floor trader, who's he's ready to tap out. He knows he's ready to tap out. Now keep in mind, this is at a time before electronic exchanges, before electronic trading cards, where the floor traders didn't have to turn their trading cards in. In other words, all the trades they made during the day, they didn't have to turn it in until the end of the day. And so the clearing firm, the brokerage firm that cleared their trades didn't know where these guys were at, meaning they didn't know how much money they would have won or lost until all these trades are reconciled with all the other brokerage firms that they traded with. And so what they would do is, if I'm ready to tap out, and so I'm going to put on this huge position that I can't afford. And so what they do just before the close, they put on a huge position. Let's say they go long T-bonds, okay? They do 1,000 T-bond contracts. And at the same time, they buy a ticket to Rio de Janeiro. And then what they do before the open, they go to O'Hare Airport and then wait for the open. And if the market opens in their favor, they come back. And if it doesn't, they get on the plane.
And actually, the way I heard it is, you know, they buy those 1,000 contracts right before unemployment, right before.
Oh yeah, whatever. Yeah, some yeah.
Yeah.
Where they take a huge guess, another yeah.
And then they go to the airport, and at 7:30 Central Time, they call up. There's the bonds. You know,
yeah.
I'll be back. I'll be right back. Oh, okay, goodbye. You know.
Yeah.
And I've got a crash of 87 story of my own that I'll share with you guys tomorrow about the clerk coming up going, "Where's your cards? Here's your cards. Don't worry, get away from me."
Oh yeah, right.
Get away from me. I really lost, and that's my biggest day ever on the day after the crash.
Wow. Okay, so you guys kind of get the idea here. This business is a lot different than what most people think that it is. Okay, it really is. And you know, and the implications are that if you don't know the reasons why other traders are extending their orders into the exchange, and then you don't know why you're winning or losing. And there isn't any way to find out. Just think about the implications of that. You don't know why you're winning or losing, which means the whole idea of being right is irrelevant. Your predictions can be right, but your reasons for making the prediction are, you don't know, you can't ever verify. You can't ever verify if they're actually correct. They might be, but if you can't verify it, then what's the point of even thinking that you're right? It only gets you into a lot of trouble. Because thinking that you know, if I'm right, it must mean that I know, and if I know, it means I can eliminate the risk the next time. And the risk can never be eliminated. So what happened to me is that I missed out on what I thought was $400,000. This really ate at me. I mean, I can't tell you just how anguished I was when this happened. And so it didn't really take much for me to say, you know what, I'm going to Chicago. And, so the first thing I did, I thought, I checked things out, and I found out that Merrill Lynch, their retail brokerage office, Merrill Lynch Commodities, they're on the second floor of the Chicago Board of Trade, and they had 3 positions they're opening. They're going to be open for trainees. And my understanding is they had over 1,000 people apply for those positions. And so, how was I going to be one of those guys that the 3? What I did, because I live in the Detroit area, I went and applied for a Merrill Lynch position at a branch office in the Detroit area. Went through the whole process because they had, aptitude tests. So you had to take aptitude tests, and but the most important part of it, the most important part of the process, I thought anyway, was that there's a multi-page application because of the tests, but otherwise there was this box at the back, at the last page, and in this box you had to spontaneously write there was a question that was asked. It was somewhat philosophical. It was somewhat of a philosophical answer because they wanted to know probably, how focused and how well you could write something like that under the pressure of being in a job interview. So anyway, what I did is I assumed that the whole process would be the same at the Chicago Board of Trade, and it was. But what I did do is I spent probably 2 or 3 weeks agonizing over every single word of that answer. I mean, and by the time I was done, I even had to admit it was somewhat brilliant. Okay, so I went and applied at the Board of Trade, and of course I aced the aptitude test because I've already taken it. And then, if the branch manager thought that I wrote that answer just sitting there spontaneously, okay, because I had it on a 3x5 card, he's got to think, this guy, hey, I'm going to hire this guy. And that's how I got the position at Merrill Lynch. So then people, it's like, no, what did I get myself into? I got myself into a $20,000 a year draw on commissions. That's it. A $20,000 a year draw on commissions. I left $360,000 for a $20,000 a year draw against commissions, and there wasn't anybody in my life that didn't think I was absolutely stark raving out of my mind. Like, how could I do it? It was easy. In my mind, I wasn't giving up anything. Now, it wasn't a revenge trade. I just thought, look, I didn't know anything about trading, and I got myself into a trade that had a potential of $400,000 on 2 contracts. What did I know about the markets? Virtually nothing. What did I know about trading? Virtually nothing. So, in my mind, did I give up $360,000? Not really. I'm going to go make this when I get to Chicago. I'm going to be on the inside of the business. And as a result, I'm going to learn how to trade. Only to find out that, especially back then, there wasn't anybody at Merrill Lynch that knew how to trade. Seriously, I'm not kidding. I'm really not. I'm not saying that facetiously in any way. They didn't know how to trade. They knew how to talk about trading. They knew how to open accounts and teach you how to open accounts. In fact, I went through a 30-day training session in Manhattan, and not one moment of that session was spent on teaching us how to trade. It was all about how to sell your customer and how to talk about trading in a way that made it seem like you knew how to trade. So when I got on the inside of the business, I was outraged. Seriously, I was enraged. I really was. It just and it took me a while to get over that too. But anyway, the problem is that here, I gave up all this income, and I had money, but it was like, I also had an extravagant lifestyle. I still had a house in the suburbs of Detroit. I had a really nice, apartment in downtown Chicago, not that far from, the Board of Trade. I had a Porsche. I had a girlfriend in, the Detroit area, and, going back and forth every weekend, and, the whole works, right? I mean, just like, just my lifestyle could only be supported if I made money as a trader. Yeah, exactly. That ain't gonna happen. And at the back of my mind, it's like right after I get there, it isn't too long for me to start figuring out. You know what? This isn't adding up. This is not adding up. It's like nobody knows what the hell they're doing with respect to trading. Anyway, I started making friends with floor traders, thinking they knew what was going on. They're in a completely different world. I mean, floor traders and direction-related traders like what we do, screen-based traders, we call each of the floor traders will call what they did as trading. We call what we did as trading. We're in completely different worlds. They did not make, in most cases, did not make direction-based decisions. They made scalping decisions that turned into direction-related trades. I'm not even going to get into how all that works. It's just not necessary. All I'm saying is that, and not only that, they're also boom and busters too. So all this is like, it's like, whoa. And so it's getting to the point where, as things are going on, and I'm doing, and not only that, one of the good things about being at the board, in that Merrill Lynch office, is that they had a computer, or a terminal actually, that had a direct phone line to a mainframe computer in Boston, I think at MIT, that I could call up a tick chart even on anything at any time. In other words, if this would have been in like 1981, if I wanted a tick chart of wheat on Wednesday, Wednesday, March 14th of 1951, it would give me one. And I'd build a tick chart, all the way to the present moment. And at the time, I was doing point and figure charts, so like I could build up point and figure charts, anytime, they're not based on time, but any box, any reversal size, and it would go back as far as the contract went back. So, and I spent almost all my time at that terminal learning technical analysis, whereas there were like almost, there were over 40 brokers in that office, and I was the only one that used it. I was the only one that used it. So anyway, like I said, things aren't adding up, and it gets to a point where I'm running out of money because of my lifestyle, and to the point where it looks like I'm going to file bankruptcy because I don't have. And the other thing that was so important in my life, even at the time, probably one of the most important things in my life was my credit. I would do anything to maintain flawless credit. Whatever it took, anything. So the idea of not being able to pay my bills was completely unacceptable to me. It was like I believed that if I had to do something like that, I would fall through the cracks of society and never reemerge. You might think I'm just saying this. These are not words. These were a reality in my mind. I could not fathom what that would be like. Just couldn't. But in essence, that's essentially what it came to. Now, if you're thinking to yourself, okay, as you realized that that you're running out of money, and I wasn't running out of money because of trading losses either. I was trading, and it wasn't because I didn't take big losses. My problem as a trader was because of all the pressure that I had of having to be successful, of having to prove that I didn't make, to family, friends, whatever, that I didn't make this asinine decision of leaving $360,000 for a $20,000 a year draw against commissions, that every trade took on the significance of, took on just a degree of importance that was just way off the chart. And so if I took a losing trade, every trade had to work. I was working off a level of 100% perfection. Every trade had to work. And if it didn't, it would set me into an emotional tailspin to the point where it took me days, if not originally almost like weeks, to recover. Now in the meantime, so to recover to the point where I didn't want to even have anything to do with the market. I didn't want to watch the markets. It was so traumatic. But as a broker, I was in a position of maintaining my customer accounts and giving them recommendations. So what would end up happening is that as I'm keeping in touch with the markets for the sake of my customers, I'm giving them my best edges, which in many cases were really good. But when I talked to them, it's like it always came with a disclaimer, like this trade might not work. And so it resonated as a truth when I said it to them. But in my mind, it was just lip service. Seriously, just like. I'm going to get into a trade that's going to work, or that's it. So what ended up happening is that I would take a loss, and then I would be in a position where I'm giving my customers my best edges, and and all I had to do was fill out a ticket for me, but I couldn't do it. I was paralyzed because this was the hard, like the situation with John about realizing that he was in a hero cycle. My cycle was that by taking a loss, I didn't deserve the next trade. It's like I was punishing myself. I didn't deserve to participate in the next trade. And when that next trade was a winner, it would like put me into a state of anguish that was so painful that it had actually the positive benefit of knocking me out of it, because it's just like the sense of self-preservation would kick in. And it would have like knocking me out of the sense of anguish that not wanting to go through that kind of pain again, I would be determined to take the next trade. especially when that next trade that I didn't take was a winner, and they almost always were. So here my customers were benefiting from these winning trades, and what I needed so desperately, I wasn't even participating in. Well, in any case, it was a real bad way to trade, so I ended up losing. Like I said, I didn't end up having to file because of losses. It was the fact that I wasn't making the kind of money that I needed as a trader. So if you think to yourself, well, okay, as your expenses were way out of sync with your lifestyle, why didn't you cut back on your expenses? Well, think about that for a moment. If I cut back on my expenses, I'm admitting to myself that I'm failing. Even thinking about it would be putting me into a mode that I'm admitting that I'm failing. And what made it even doubly more difficult to make that admission is the fact that I had a really good win percentage. I came up with good trades. If I could execute them, I'd have been all right. So it just always seemed like I was only 2 or 3 trades away from everything being all right. So how can I admit that I'm failing? Until I literally did not have any more money to pay my bills. And then I called, credit cards, and even called GE Credit, who, had the Porsche, and that wasn't even late. Wasn't even late. I said, hey, come and pick up the car. I can't pay for it. They're out in Bloomington, Illinois. And what was really interesting about that, you want to hear this? I don't know if you want to hear it. It's a cool story. The guy they told to come pick it up, I met him out in front of the apartment building. And I can't use the exact language his supervisor used, but I'm thinking, you know what, this guy's picking up my car, or what was my car, and I want a note that says what condition it's in. In other words, I go back and make things right. I don't want the car, going back to GE Credit, dented up or whatever, that, any kind of situation that I didn't occur. And I said I wanted a note. And he said, I'm not going to give you one. And I said, you're not going to get the car. And so, we went back and forth on this. So finally, he walked into the lobby and called the supervisor. And I could hear his supervisor on the other end. I said, if you have to blah, 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 this guy's whatever, you get whatever you do whatever you have to do to get those keys. He's screaming at him. So anyway, I can't use the language, but it's like you can imagine what he said. So, but yeah, so what ended up happening is that I lost all my possessions, other than the fact that I still had my job at Merrill Lynch. When I filed, I did so in the Detroit area because I had a legal residence. So nobody at Merrill Lynch knew what had happened. They would have fired me immediately. And I was in the unique position. Now here's what's really critical about all this. I was in the unique position of legitimately having tapped out as a trader and still able to trade. Still being connected with the markets. And I had also the added benefit of just always sort of knowing right from the very beginning that trading was about psychology. As a matter of fact, the very first book I ever bought the very first trading book I ever bought was Jake Bernstein's Investor's Quotient. It was published by Wiley in 1980. It was more on a clinical level, but that was the very first trading book I ever bought. It was on psychology. The only one actually, like I said, the very first, I don't consider Reminiscence of a Stock Trader like a real psychology trading book. So Jake's was the very first book. Actually, The Disciplined Trader was only the second. The Disciplined Trader came out in 1990. At that time, it was only the second book ever written on the psychology of trading after Jake. And even at that time, there weren't any universities that had behavioral finance programs. It just, the whole idea of trading psychology in the industry was completely this doesn't have anything to do with anything. So anyway, so what ended up happening is that it was real cathartic because I ended up realizing that I was more than my possessions. I think after, I don't know how many weeks it took, but I was starting to reassess my identity. When you have all these possessions, that are on the outside of you reflecting what's on the inside of you, and then all those possessions are gone, it's like you've got to reassess who you are. And then I came to the realization that, I'm more than my stuff, and I'm going to be all right. And it's when I really genuinely came to the conclusion I was going to be all right that I didn't have anything to lose anymore. And I saw a different market. I'd come in and it's like it was like almost like things became self-evident. When I didn't have anything to lose, it's like I was completely detached from the outcomes. And with being completely detached from the outcomes, I was in an objective state of mind and it all became easy. It really did. Someone has a story here. I don't remember your name, sir. Oh, because you didn't have a tag on. Scott, you want to say your story? Yeah, you've got 15 seconds.
I've been trading about 14 years now. It was sort of on my own, trying to learn from two other guys who were 3-point license. And I learned a lot of bad habits by taking losses and taking personal. And I had read one of the books 4 times total. The 3 times before, I understood the story, so I didn't make the connection. And the 4th one, it happened after I took the loss of what I considered starting. And it was 2 points dislocated right at the head. You had nothing left to lose. So when I read the book, October, November,
The 4th time, yeah, the 4th time.
I get it. And my trading was hard because I know I was not trading with the money. And I kept myself because I was that's problem. And then in the spring, I worked with John, and the walking case trade where Tom was teaching the case how to trade for a month. And the full grain weekend, I watched 4 or 5 months of stuff, and I got it. Sold off in that one morning, and then I got a 54% capital. So I go ahead, it was like, that's fine. The trade futures don't have a lot of time to go on. This gave another tool to go off the trade, and it sounded fun. The last 4 months, it's a pain in the but and he said that put that stress from doing something and you made it easy. So that was kind of my story. Now my trading some funds that we can start to fund and enjoy it.
Thanks, Scott. Appreciate it. Thank you. Forgot to put it up there. It's all right. So anyway, before we break for lunch, there's some stories that I want to go through that will illustrate these points when I was at Merrill Lynch. First of all, if you're interested, why did I leave Merrill Lynch?
Yes.
Okay, I got fired. And no, the reason why I got fired is because in the summer of 1982, this whole situation was like around April of 1982. By July of 1982, I'm thinking, you know what? As I experienced a different market because my perception, my perspective had changed, I thought, you know what, I got to write a book about this or a seminar. I didn't think about really a book, but I thought more like a seminar. And I actually started writing it in July of 1982 in the boardroom overlooking LaSalle Street. There was a huge picture window there, you know, on the second floor of Merrill Lynch, okay, or second floor of the Chicago Board of Trade. Anyway, about 9 months later, 9 or 10 months later, some management consultant from New York came to our office. She had some agenda. I don't remember exactly what it was, but she was interviewing all the brokers, and she got to me. And I told her that I was writing this book on the psychology of trading. She lit up. I mean, she honest to God, she just lit up. And we talked for about an hour. And I told her what I was doing. She said, "This is exactly what we need. Boy, this is great." Blah 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 blah. And so, you know, when we were done, she went right into the manager's office. She was in there for about 15 minutes or so. Manager came out and said, "Pack your shit up and get out of here." Did not want anybody on the inside of the industry writing a book. Now, you know, it's not that he didn't know what I was writing about. He didn't want to take the chance. He just said, "Get out." That was it, right then and there. So I said my goodbyes to everybody and left. But anyway, here's some things that illustrate some of the points that I learned while I was at Merrill Lynch. One, there was a book that I bought, New Technical by Wells. I don't remember the name of the book. Anyway, all it was about 5 or 6 technical, rudimentary, by today's standards, very rudimentary technical systems that Wells Wilder, the author of the book, actually gave you a spreadsheet for, so you could actually, you know, do all the additions, multiplications, and divisions all by hand because we didn't have computers, and based on daily charts. And some of these signals were really quite accurate. I mean, they really were. They're based on, like I said, daily charts. They're really quite accurate, and so I started using them for my customers, and so one of the things that surprised me, because I was making friends with a lot of floor traders, is that when I got a signal, in some cases it was absolutely perfect. It's like, get me in a trade that, you know, that I didn't take any heat on whatsoever. And I'm thinking, you know, like, I remember exactly thinking, like, is this the reason why the market's going in my favor? But I do have a recollection, like if it was a bond trade, of going out to have some beers after the market with bond traders, and they're telling me about the activity in the pit, who's buying, who's selling, volume. And I'm thinking, there is no connection whatsoever between my winning trade and why the market went in my favor. I mean, zero. Were those 4 traders using this system? Absolutely not. Zero connection. The next one. Sophisticated financial news channels didn't exist back then, but we did have this local cable channel in Chicago that during the day had financial news or whatever, stories. And it was really, like I said, really rudimentary by today's standards. So the TV would be on constantly, so you could watch it if you wanted. And we also had, like, CNBC, like what they called, like in the morning they called Squawk Box. Well, everyone know what a Squawk Box actually is? Because they really exist. A Squawk Box was an open phone line between all the different pits that would be traded. That we would, we'd have a speaker located in various parts of the office so everyone could hear it, and there would also be an open phone line in, like, the hog pit, the bellies, the T-bonds, the S&Ps, you name it, the currencies, whatever. And there would be Merrill Lynch employees whose job it was to go to these various pits throughout the day and report about who was buying and who was selling and how much. Like, okay, so-and-so is doing this, so-and-so is doing that. And so I'm watching this local channel, and they're interviewing some vice president from Heinhold Commodities. Heinhold Commodities, I don't think they exist. I'm sure they don't exist anymore. But they used to be one of the biggest hog producers in the world at the time. And so their vice president was being interviewed by the guy on this cable channel, and he's just talking up, buy hogs, buy bellies, and it's like, and the office was relatively quiet at the time. Then all of a sudden the phones started lighting up, literally, and lighting up because you had a lot of local commodity traders, off the floor traders in the Chicago area who watched the station. And so what are they doing? They're buying hogs. They're sending orders to their brokerage firm, and in this case, Merrill Lynch, buying hogs or buying pork bellies. And so, this is a coincidence. It just so happened because the guy, the Merrill Lynch employee on the floor, whose job it was to report what was going on in the pits, he wasn't watching that station. He wasn't watching the local news cable station. He didn't have any idea that there was some Heinhold vice president on TV telling basically retail customers to buy hogs. But he just happens to walk into the hog pit because he hears all this activity. He sees all this activity flowing into the pit, especially into the retail brokerage deck holders, and he wants, he'll go report on what's happening. So he goes on the pit and say, yeah, all these retail orders are sure sent Merrill Lynch, blah 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 blah. And guess who's on the other side taking? Guess who's on the other side taking the sell side of those orders? Heinhold. They needed inventory. They needed buy inventory to absorb their hedge without affecting the price of the market. This happened a lot. This was not an isolated incident. This is the kind of stuff that goes on all the time, or did. This probably still does. I don't know. And so, and the next one, the last one that really like I had, where I really for sure had to write a seminar, is because when I was at Merrill Lynch, what I saw is all of our customers making all the same kind of mistakes over and over and over again. It was just like there's the typical things that we all basically had the same problems and making the same kind of mistakes. And I inherited this guy as a customer. He was from India, had a real heavy Indian accent, and he was the main. He ran the state of Illinois' main computer banks. In other words, the mainframe computers. And as a result, since he had access to these computers, he was also developing trading systems using the computer. And so, like I said, I inherited him as a customer. He didn't have an active trading account because his wife wouldn't let him trade anymore. But he did have an open account. So he would call me every day, and he was not a very personable guy, because I'd pick up the phone and he would say, give me data. Okay, so I give him the data that he needs. And eventually what he did is he came up with a system that was really quite accurate. In other words, at least entries anyway. He had really accurate entries on a daily trading system, like on the open, on the close kind of thing. What he didn't have was exits on the loss side and profit objectives. And so I worked with him for about a month on this and came up with a really viable system. It was working, and not only was it working, it was starting to take notice from Merrill Lynch management because my customers were making money. Literally, I mean, that's not something that really happened in a retail brokerage firm. So, and then it got so good that he talked his wife into putting $5,000 in his account, and it was like, whoa, it was gone in a day and a half. It was like he called me with the signals, but then he'd say, well, do this. I said, well, no, our signal, we're going to do this for his account. No, do this. I said, no, the signal is to do this. He said, I know what's going to happen, do this. And he lost the $5,000 like that, just like that, not following one rule of his. We had a track record. We had a legitimate track record that was working, and he couldn't take one trade from his own trading system. He pissed away the $5,000 in a little under 2 days, and his wife said, that's it, no more. And that was it for me, too, because, he closed the account and I never heard from him again. And since we didn't have mainframe computers, nor did I have access to what variables he used to call for the signals, it was done. It was those kinds of experiences like, you know what, I got to do something to, get people in tune with what's really going on here. First of all, don't let me forget, tomorrow I'm going to start out showing how fear causes us the fear acts on our perception of information and our behavior in a way that causes us to actually experience the very thing we fear the most. And then we're going to put it all within a context of a step-by-step methodology of how to actually instill these principles in your mind as core trading beliefs so that you're not afraid anymore.
Your story about newscasters that say 5 pork bellies and then
hogs, yeah, right.
Is that sort of opposite of what you said? Like, how do you know that's what it was? How did that influence you?
What do you mean? What are you saying?
People always say this is why things happen, but nobody knows you can't prove anything. You're just stories.
Okay, but what does that have to do with what the story that I said?
Pork belly.
Yeah, he did that because he did. No, he went on TV to tell people to do that, so there were orders to take the other side of his trade. He needed inventory. In other words, remember, prices move based on an imbalance between the number of buy and sell orders that come into the pit. But he's a hedger. He doesn't want the price. He doesn't want his sell order to cause the price to go down because it reduces his average price. He wants to sell at the highest price possible. The only way to get his price at the highest price possible, if there are enough buy orders to take the inventory of the amount of sell orders he has to sell. So he went on TV encouraging people to be buyers so that there were enough orders to fill his hedge. He didn't want the market to move. Go ahead. Oh, in this case, yeah, absolutely. Yeah, see, remember, I didn't say that was an absolute. I didn't say it was an absolute because the Merrill Lynch employee was right in the pit seeing who put the order in. He still didn't know why. The Merrill Lynch employee said, hey, you know what? High and hold is selling. Here's how many. He didn't know that they were putting on a hedge. No, it wasn't a good bet at all, actually. No, it was a complete scam. No, what are you saying? No,
I understand that this person ordered maybe based on this.
Maybe we say ordered. Ordered what? What do you mean? I mean, place a buy order or a sell order? Okay, they're putting buy orders in.
Earlier you're saying you don't know that people are like market looking much but buying.
Right.
Looks like this guy came on TV.
Oh, absolutely. Yes. In this case, I would say because the coincidence of the phone, of him being on TV and the phone's lighting up, yes, I could say in this instance that probably the reason why those buy orders were flowing into the pit, yes, did I know at that? Yeah, the probability is, yes, it seemed like I contradicted myself, but I really didn't because as screen-based traders, remember, I was on the inside. I was in a brokerage firm with access to information that we don't have as a screen-based trader. Remember, I qualified it by saying as screen-based traders, there's no way to know. Was that part of your question? Okay. Yeah, remember, I was on the inside. So I could see the correlation. Go ahead.
Did you ever ask
any or all of the students who never did any of your protocol, why they never did it? Going back about a quarter of the way from your presentation that you talked about.
No, I normally, no, I wouldn't ask. That's not something. No, I kind of know why. I can extrapolate why, but no, I wouldn't ask. I really wouldn't want to say, actually. You know, I don't want you guys to not do it. Okay, so you know, what? Well, you might not want to if I gave you the answer. It's right. It's what you're going to learn. Not everyone's ready. Not everyone's ready to step into what they're going to find out about themselves. That's right. Not everyone's going to want to know what they're stepping into and what they're going to learn about themselves, because the implications are pretty powerful. You know, it takes away a lot of people's excuses for being unhappy and a lot of negative things that go on in their lives that they'll learn they can do something about. Because if you can change one belief, you can change any belief. So there, I answered the question. That was a good question, by the way. And, one other thing. Another thing. Okay, because I don't think I finished this. Yeah, another example. There was one particular example where the bond market had really established support and resistance zone. Okay, and this was an intraday trade, and the market came down to support and bounced right back up off, came down to support again, bounced right back, and now it's coming back down again, right? Okay, and so like the third time, well, I'm getting everyone in this trade, and what does the market do? It just blows right through it. Now, it's like under normal circumstances, I wouldn't have the slightest idea what happened. It just so happened that because, again, I was having beers with guys in the bond pit that, you know, who were in the pit that day, asking them, hey, you know what? When the market was at this price and it bounced, the market was at this price and it bounced, and then it hit it again, like, you know, an hour or so later, and it blew right through it. What happened? Oh, well, there were 4 or 5 really big bond traders who were supporting the price here. In other words, more buy inventory than sell inventory. They did the same thing again here. They were out to lunch here. They went to lunch. I lost money my customers lost money because they went to lunch. That's why the trade was a loser. Hey, see you tomorrow.